Okay, there's a last topic I want to talk about under monopoly. So what have we learned in monopoly? One of the things is that the pricing instrument of the monopolist, of course, matters, right? If the monopolist has to charge just a simple flat unit price to everyone, and regardless of the quantity they're buying, then we have underproduction relative to what is socially optimum, and we have deadweight loss. And there are two aspects to the problem. One is perhaps a distributive issue that using his market power, the monopolist can take away a lot of consumer surplus. So consumer surplus shrinks relative to a competitive market and profits increase. But that distributive consequence is different from the efficiency impact of a monopoly, that monopoly also creates deadweight losses. The increase in profits is smaller than the loss of consumer surplus due to monopoly, right? But we also saw that if the monopolist can exercise more complicated kinds of pricing, like two-part tariffs, for example, or price discrimination, directly or indirectly, then that you can see my screen, right?
Yes, sir.
Yes, sir.
Okay. I wanted to go to the other view, but I forgot. Anyway, let me continue with this. Yeah. So more complex instruments, pricing instruments, remove the inefficiency, but they lead to even further inequality between the seller and the buyer, right? And that may be problematic. In yesterday's lecture, we also saw how the monopolist can use clever ways to price discriminate, even if he doesn't have good information at the outset about the willingness to pay of different buyers. He can tease out that information using the kind of sorting techniques that we talked about. Now, so the overall message, if you take away the let's go back to flat unit pricing, which gives rise to deadweight losses under monopoly. So that has implication for policy, right? The Competition Commission or the antitrust authorities would like to prevent monopolies from arising. So whenever they see, firms merging and the market tending towards a monopoly, they will sit up, take notice, and try to prevent that. Now, that lesson applies to products where the firms which are perhaps merging to form a monopoly are selling either an identical product or very similar products, firms which are selling close substitutes, right? There, that lesson is true. What if the firms sell complementary products? So for example, if Intel, which makes chips, is merging with a PC manufacturer like Dell or Hewlett Packard, who have you, then is that socially good or bad? Should antitrust authorities try to prevent it or not? That's a separate question. So mergers to form a consolidated monopoly will be bad if the two monopolists were selling substitutes or close substitutes. But in the case of complements, we have to think differently. So that's what I want to talk about today at the beginning. So let's think of vertical mergers. What is horizontal mergers? It's like Dell and Hewlett Packard merging to become one large PC manufacturer. That's a horizontal merger. Whereas Intel and Hewlett Packard merging is a vertical merger, right? What does that mean? That means one of the firms sells what is called an upstream product, and the other sells a downstream product, right? The upstream product goes into making the downstream product. So one example is that there's a logging company which makes Y, which is wood, and that goes into making furniture, X, right? And there's a separate monopolist. There's a logging company which has a monopoly on wood or timber, and there's a furniture company like IKEA which has, let's say, a monopoly on furniture. So if they merge, what will happen to social welfare? In particular, what will happen to consumer interests? That's the question we want to understand. So I'll present a very simple model to illustrate what happens. And the lessons go far beyond the very simple model. So let's assume a fixed coefficient technology. What does that mean? That 1 unit of wood is needed to make 1 unit of furniture, let's say, right? And the separate monopolists, they have constant marginal costs. CY is the marginal cost of wood, of logging operations. And CX is the marginal cost of making furniture. So the furniture company will have to buy wood at some price from the logging company. And then CX is the cost of manufacturing, the cost they have to pay to the carpenters. So their marginal cost will be the CX plus whatever price they pay for the wood, right? And for the logging company, CY is the comprehensive marginal cost.
So what do you mean by downstream product X and upstream product Y?
Product is the product which is an intermediate input, right? And that goes into making the downstream product. Downstream product is the final product, like furniture. Upstream product is an intermediate input in furniture making, which is like wood, right? These are just terms. It's like, the production process is like a stream. The upstream product is made first, and then it flows into the downstream manufacturing process. Yeah.
Oh.
So there's an inverse demand function. So consumers don't buy the upstream product or the intermediate product, which is wood. They buy furniture, right? And this is the demand function. This is the inverse demand function for furniture, right? To sell X amount of furniture, the monopolist can charge a price P of X.
So,
yes.
What is C by?
Sorry, say that again. What is what?
C by marginal cost.
This is the marginal cost of making the product Y, which is wood.
Okay, sir.
And CX is the marginal cost in terms of labor cost or manufacturing cost for making furniture. So the total marginal cost of making furniture will be CX plus whatever the price of wood is. Right?
So in this, we are assuming that the upstream product is not being sold to consumers directly in any way.
Yes, I mean, who buys? We as consumers don't buy computer chips or cell phone components or just raw wood for which is used for furniture. We buy the final product, right? Yeah, so that's the assumption. All right, so this is our inverse demand function. So you can write down a revenue function, R of X, which is P of X times X. Yeah. Now,
can you please explain horizontal versus vertical merger again? Just what exactly is horizontal merger? Like in this case, it's horizontal.
So if two firms are selling identical products or products which are very close substitutes, and they merge, that's a horizontal merger. Example, Hewlett-Packard and Dell merge, that's a horizontal merger because both of them are selling PCs. Yes.
Okay, sir.
Vertical merger is where two firms merge, but one of them is making an input for the product of the other firm. Right? That's called a vertical merger. Example, Intel merges with Hewlett-Packard.
Yes, sir. Got it, sir.
So first we'll consider what happens when the two monopolists are separate. The furniture company and the logging company are separate monopolists in their respective markets. All right. And let's say the logging company, that monopolist, charges a price of Q per unit for the wood that they are selling to the furniture company. Right? This Q, of course, will be endogenous, but let's call that price Q. Now, we will solve this problem under this market structure using what is called backward induction. You will learn more about backward induction in game theory in the next micro course, but it's fairly intuitive, so I'm going to use it here. Basically, we have to solve the problem backwards, right? So the downstream firm, the furniture company, is quoted some price Q by the upstream firm, the logging company. And given a Q, they will do their own profit maximization, and that will lead to some demand function for the intermediate product, namely wood. Okay. Now that derived demand function will be used in the next step to solve the profit maximizing problem of the upstream firm, right? So we first solve the profit maximization of the downstream firm, the furniture company, who sells the final product. And from that, we use the derived demand function, their derived demand function for the input, to solve the upstream firm's profit maximization and pricing. All right. So let's look at the downstream problem. They're maximizing revenue minus their total cost. Now, their total cost, as I said, consists of these two parts, CX plus Q. Q is the price they have to pay for the wood, and CX is the cost to convert wood into furniture, right? So this is what they're maximizing. And you have the standard first order condition that marginal revenue equals marginal cost, which gives us this.
Sir, can you explain what is a Q?
Q is the price of wood. Q is the price of the product which the upstream firm is selling. As this line says, right? Yes, go ahead.
Yeah. Sir, so CX, the marginal cost here is constant, right?
The marginal cost is what?
It's constant here. That's why we are using CX plus Q multiplied by X.
Yes, we have taken it to be a constant. That's right.
Yeah. All right, sir.
Right. So one element of the total overall marginal cost of the furniture company, one element is exogenous, which is the cost of converting wood into furniture. But the other element, which is the cost of wood that they have to pay, right, that is endogenous because that is chosen by the other firm. But as far as this guy is concerned, the furniture company is concerned, Q is given. They are not choosing it, right? It's the other monopolist, their supplier who's choosing it. Okay, so this is the standard condition. All right. Now let's go back a step and look at the profit maximization of the upstream firm, the logging company. Their quantity is Y, right? So what are they trying to do? They're trying to maximize this. All right. This is their profit. Now, what is the price? What is Q? Remember that this last line we had, the profit maximization condition of the furniture company, that tells us the relationship between the price of wood that can be charged and the amount of wood that will be demanded by the furniture company, right? So this is implicitly the demand for wood coming from the furniture company. Yes. So what we can do is we can take this CX to the other side. So we can express Q as R prime X minus CX, right? This expression, because that is basically the inverse demand function. So the inverse demand function here is Q equals R prime minus CX. The only thing we have done is instead of X, we have replaced it by Y because that's the quantity that this firm is choosing. And the reason we can replace X by Y because the production function is very simple. The production function is constant coefficient 1:1. So 1 unit of wood converts to 1 unit of furniture. So X and Y become interchangeable for that reason. Okay. So the profit function can be written equivalently like this using the last line of the previous slide, which implicitly what that means is that we are using the inverse demand function of the furniture company in this maximization exercise, because the logging company can anticipate what the demand function of the next guy is going to be, and they take that into account in solving their profit maximization. Okay.
Can you please repeat, why did we write y instead of x in r dash?
Because the production function is basically y equal to x, right? This part, fixed coefficient technology, 1:1. That's written somewhat cryptically, in a cryptic manner. But what
So that's like an assumption that y is equal.
Yes, that's an assumption.
Okay.
Right. We have just taken it as a given. Nothing depends on, I can make a more complicated production function, and that'll just, instead of replacing x by y, I have to replace it by the production function, whatever the complicated production function is. But let's keep life
Okay,
simple.
sir.
Yeah. Okay. So this is the maximization problem. So you write down the first order condition. I'm again being a little cryptic over here, but if you write down the first order condition with respect to y, and then replace that y by x double star, right? You'll get an optimum y, but again, because y and x are interchangeable, I'll just rewrite it as x, right? And I've put a double star to denote what is the value of x and the value of y when we have separate monopolists, right? When we have a merged single monopolist, then we'll denote their choice by x star. So at the end of it, we'll compare x double star with x star and see which is bigger, which is smaller. Okay, so from the first order condition, we arrive at this, right? R prime x plus this term involving R double prime equal to this. We'll assume our marginal revenue curve is downward sloping, right? Which will be usually the case. So R double prime is negative. Okay. So this equation is critical. This equation tells us when we have separate monopolists, what is the output level of furniture and wood. Now, let's consider a second scenario where the two firms have merged and become a single monopolist. So now the wood is supplied in-house, right? So now let's write down the profit function of profit maximization problem of this single monopolist, single entity. And that's very simple. It's this, right? The X is the amount of furniture that if they're trying to sell X amount of furniture, they have to price appropriately, and they'll get the resultant revenue given by the revenue function R of X. And what is their marginal cost? Their marginal cost is that they have to get that amount of wood, and that costs this C subscript Y. And then they have to pay the cost of converting that wood to furniture, which is CX. So this is the overall marginal cost when we have a single firm, single monopolist. And what's the first order condition for this problem? Very simple. Marginal revenue equals marginal cost, which is now CX plus CY. Okay. Now, and we have put a single star here. So X star is the production level for a merged single monopolist. X double star will be the production level when we have two separate monopolists. So which is bigger? Okay. So for that we have to.
Sir?
Yes.
X double star will donate the production of both the firms, upstream and downstream, in the first. Yeah.
Yes. X double star denotes the amount of furniture produced in this equilibrium with two separate monopolists, as well as the amount of wood, because there has to be a one-to-one relationship between them due to the technology that we have assumed. Right? So
yes.
In either case, the quantity X star denotes both the amount of furniture produced and the amount of wood that is supplied.
But so this first order condition X star star is just for the upstream monopolist, right? When it takes into account the demand for the downstream?
It's for both. That's what I'm saying, right? It's for both. Because the technology is Leontief type 1:1, right? Meaning that if X double star amount of furniture is to be produced, then the amount of wood that is needed to produce it is also the same.
Okay.
So X double star is both the amount of furniture and the amount of wood. So is X star. Is the amount of furniture and the amount of wood produced by a single merged monopolist, and this is the amount of furniture and wood produced by separate monopolists. Right? And now the comparison is fairly simple. I can kind of draw a picture to convince you that, that X star will be higher. Okay. So let me draw that picture. So both the equations that we have on the right hand side has Cx plus Cy, right? In the first equation, you have marginal revenue equated to that. So if I draw the marginal revenue curve, some downward sloping thing, that intersection gives us, sorry, this is the second case. That intersection gives us X star. This is when the two monopolists, the two firms have merged. Now, if we had them separate, then our first equation said that marginal revenue plus a second term, which is the derivative of marginal revenue, equals this Cx plus Cy. So that curve will be lying below, right? Because it has an extra negative term. So for every X, this curve will have a lower value. So this curve will intersect at a lower point, and that lower point is exactly what X double star is. Yes? So if there's a merger, then output will go up. What will happen to prices? What will happen to the price of furniture?
So it will decrease.
Price will decrease. So consumers are better off or worse off?
So they'll be better off overall as the consumer surplus will increase.
Obviously, they're better off because the price that is relevant to them, namely the price of the final product, furniture, has gone down. So they can't be worse off. It's good for them. The two firms who have merged, are they better off or worse off?
So they must be better off.
They would
So
be
it
better off.
seems like it may be uncertain, depends on the case.
Sir, if they are worse off, they won't merge then.
One of the things, see, sometimes there's a very simple argument, a dominance argument, okay? So before the merger, they were producing X double star. Now, after the merger, one of the options which the single entity has is to stick to the same production level, isn't it? And if they stick to the same production level, the combined profits of the profit of the merged firm is equal to the combined profits of the separate firms earlier. Right? No decision has been changed. So prices and quantities have remained the same. So their combined profits in that case remains the same. So one of their options is to not change their decisions at all after the merger. Right? Now, the fact that it's optimal to change the decision means that their profits can only go up. They could have stuck to the same amount of furniture production, but they didn't. They produced more, and that must be because it increases their overall profits. Right? So this dominance argument tells us that after the merger, the combined profits cannot go down. It can only go up. In fact, it'll go up strictly. Right? It'll go up strictly if this R double prime is strictly negative. Yes? So,
excuse me, sir.
Yeah.
Sir, in the first slide, we have assumed that the total revenue is decreasing. Why is that so?
No, we haven't assumed total revenue is decreasing. We have assumed marginal revenue is decreasing.
Plus, in the third point, we've written Rx, Px into X is downward sloping. So what does that mean exactly in this context?
That's a typo. Yeah. I meant R prime X is downward sloping.
All right, sir.
Again, please
So
correct that in your notes. Yeah. R prime X
also,
is downward sloping. The
so
derivative of this revenue function is negative. Yeah.
so
The
I was
derivative
saying,
is downward sloping. The second derivative is negative. Yes, go ahead.
so in such type of cases, how like it is decided that like percentage of profits that will go to the upstream firm and the downstream firm, and like
Well, yeah, good question. It doesn't matter, right? So you can think of the merger happening in many different ways. For example, one of the firms, let's say the furniture company, can maybe buy up the logging company, right? And if they want to buy up the logging company, the price they have to pay should at least be the profits that the logging company was making earlier, right? So when there were separate entities, let's say the logging company was making 100 rupees of profits and the furniture company was making 200 rupees of profits, right? So if they offer a price of anything more than 100 rupees, then the logging company would be happy to sell to them, right? Or the shareholders will be happy to sell to them. Now, what we are saying is that after the merger, before the merger, the combined profits were 200 plus 100, which is 300 rupees, right? After the merger, it goes up to, let's say, 400 rupees. So that means, for example, the furniture company could make an offer to the logging company and an offer price of, let's say, 150 rupees, okay? Now, those guys were making 100 rupees of profit, so they're happy to sell at a price of 150. And the furniture company was making 200 rupees of profits. If they buy it up at a price of 150, combined profits go up to 400, they're still left with a net profit of 250. So as long as their combined profits go up, there's always room for a win-win transaction. Yes? Now, the exact selling price will be how much. They'll probably bargain over that, haggle over that. You know, we can use bargaining theory, Nash bargaining solution, whatever. We are not going to try and pin that down. The general point is that if the combined profits go up after a merger, there will always be room for a deal which both parties will be happy to agree to.
okay, so got it. Thank you.
Yeah.
Sir, how is the combined revenue curve like above the separate revenue curve in the diagram that you just drew?
So what is the second term? If you look at when they're separate monopolists, this is the relevant equation. So what you have on the left hand side is R prime, marginal revenue, plus an extra term which is negative. Yes. So if I plot that graph has to lie below the marginal revenue curve, right? Because at every quantity, it is marginal revenue minus something. So we have to drop down.
Okay, so on the first slide, the typo was that R double dash X will always be less than.
That's right.
Okay, thank you.
Sir, if we are still talking about two parties, what is the meaning of merger then? It means that the marginal cost of producing wood would equal to the price
I'm
that
sorry,
the downstream
you're getting cut
would
off.
pay.
Please. Could you repeat the question, please? I didn't fully.
Hello.
Yes.
Sir, if we are still talking about two parties after merger, what's the meaning of merger then?
We're not talking of two parties. So two monopolists merged. Then the firm, the single firm after merger, right? That firm just has a logging division and it's solving a single profit maximization problem. And in that profit maximization problem, the cost of logging as well as the cost of manufacturing the furniture, they're added up, CX plus CY. So there's one single maximization problem that is being solved here. We were treating them separately when they were indeed separate, being the pre-merger situation. Here we are not. It's just simple two steps. Right?
Okay, thank you, sir.
All you have to do is to when after merger, what the single firm has to do is to count all the costs, the cost of logging as well as the cost of furniture making. But we have counted that by adding them up. And it's a single maximization problem, right?
Sir?
Yes.
Can you please explain like how the consumers are better off in terms of price? Like after merger, the price of furniture will go down.
The quantity will go up. That's what we just proved. After merger, there's more production of furniture. Now we have a downward sloping demand curve. So the only way consumers will buy that extra amount is if the price is lower.
Okay, sir. Yeah. And the consumer surpluses will also go up.
Obviously. Right? So it's a Pareto improvement. The merger is a Pareto improvement. Everybody's better off. Right? So we said lots of bad things about monopolies and firms merging to become a single firm. Those points were relevant to horizontal mergers. In vertical mergers, as we see, not only, I mean, everyone can be better off, right? Let's try to... Yes.
So the thing that you pointed out that it is a typo that Rx is equal to Px into X should be downward sloping.
Yeah.
So isn't it that that condition only ensures that producers are better off, since revenue is inversely related to price, means that equation shows that if Rx is downward sloping, so when price decreases, quantity increases, that it leads to increase in Rx. So that should be true, and that leads to the case that producers are better off. Isn't it like that?
The argument for producers being better off after a merger is way more general. You don't have to assume anything at all, right? Because, as I said, there's a very simple dominance argument that after the merger, all the relevant decisions in terms of, quantity of production, etc., and pricing can be kept the same. So one of the things that the merged single firm can do is exactly replicate what the separate monopolists were doing earlier in terms of production. And that'll keep the combined profits at the same level. So that argument is simple, general, and sweeping. Now,
so I'm just saying that then that statement isn't wrong.
Which statement?
That you mark that is a typo. That shouldn't be wrong.
I'm telling you, hold on. So to show that consumers are better off, that relies on us showing that after the merger, quantity will actually go up and price will go down. And for that, we need, this term to be negative. So that is relevant to showing consumers being better off, but not for firms being better off. Firms will be better off after a merger anyway, in every situation. At worst, they can just, their profits will be preserved at the old level. It can never go down. Right?
Okay.
So you're right, that assumption plays a role in showing increase in consumer surplus. Okay. Let me get to the intuition of this. Everything, all these things are, what is important to understand is going beyond the maths and the algebra. The maths and the algebra sort of puts us on firm ground, but we have to understand the intuitive reason. What is the intuitive reason? Can somebody take a guess? Put it in words so that we can wrap our heads around it. Why is it happening that after the merger, quantity is increasing and price is falling? Why is that?
So the economies of scale, can we consider that as one of the factors?
There is no economies of scale in the production functions. They're linear. They are constant returns to scale, obviously, because we have linear cost functions.
Sir, initially the downstream firm used to perhaps accommodate the cost or the margins that the upstream firm would charge. Now they don't have to. Those are incorporated within the merged entity. So now it is able to perhaps pass that on to the customers.
Something along those lines.
Sir, now the choice variable has been internalized.
Yes.
Earlier, one of the firms was taking the other's choice of output as given, but now the decision is being taken
Sure.
simultaneously.
So the fact that,
It's internalized in a way.
So after a merger, the profits from the upstream operations and the downstream operations, when deciding what should be, how much amount, what quantity of logging should take place, in that decision, the interest of the downstream division of the company, namely the furniture division, is now being internalized. You're right about that, right? But so that would explain why the choice may be different after the merger. But why does it go up rather than go down? For that, we have to delve a little more into the detail about, you're absolutely on the right track, but the answer is not complete. Yes. Let me complete the answer. Yes. You've taken us halfway. One key idea in economics, which will be very, very useful in thinking about a lot of problems, is the idea of externalities. Under certain arrangements, if there are externalities, the decisions of economic agents is wrong, right? When there's negative externalities like pollution, firms overproduce. Why is that? Because some of the social cost is not getting counted, right? The cost, some of the social cost is the health expenditure due to pollutions, health damage, the damage to crops and fisheries and so on. So the chemical plant, which is deciding how much to produce, is not counting these costs. That's why they are overproducing. And if we had positive externalities, they would underproduce. This is a very key intuition. You have to have it absolutely lodged in your brain. Now, when we think of the two monopolists, right, let's go back to the initial situation, pre-merger situation. When the logging company is choosing its price, right, of wood, and the furniture company is buying that, what is the nature of the externality? If the logging company increases its price, right, it has some impact on its own profits, and it has a negative impact on the profits of the downstream firm. And before merger, it's not counting that negative impact. So as far as pricing decision of the logging company is concerned, there's a negative externality, right? Part of the cost or part of the effect on profits of increasing price of wood is borne by the downstream firm, by the furniture company, and the logging company was not internalizing that cost, right? After the merger, that cost will be internalized. So whenever you have negative externalities, too much is done. So that means since when the price of wood was being chosen by the logging company before merger, they were pricing too high and therefore producing too low. After the merger, therefore, production will go up and prices will fall. This is called the double marginalization problem, right? When you have a final product coming through various monopolists, each applies a markup. At each stage, the monopolist creates some inefficiency, creates some scarcity for his own product and in the value chain, and jacks up prices. And so the monopoly distortion happens twice rather than once. After the merger, the monopoly distortion happens only once. And so before the merger, there was a greater inefficiency, there was a greater underproduction because of the double marginalization problem, because the monopoly distortion was being applied twice rather than once. After the merger, it's still not completely socially efficient because, because the absolutely social surplus maximizing output would be even higher than X star. But at least we have moved in that direction because the double marginalization problem has been reduced to a single marginalization problem. Right? So in some situations, one monopoly is better than two monopolies. One very powerful firm could be better than two firms controlling different aspects of the production.
So,
Yes.
sir, in the pre-merger case, if there was a negative externality, shouldn't there have been an overproduction in the pre-merger case, and in the post-merger case, it should have decreased?
No, when I said negative externality, I was referring to with respect to pricing.
I'm still confused. So why doesn't it lead to an overproduction in the pre-merger
Okay,
case?
so let's go step by step. Go back to the pre-merger situation. Focus on the logging company, the upstream firm. First, let's pick prices, right? If they increase prices, their prices for their good, that has a negative effect on the other firm, right? So there's a negative externality with respect to raising prices.
Oh, okay.
Now, if you want to think in terms of quantities, let's think what happens if they increase their quantity, the amount of log or wood they are producing. That actually has a positive externality downstream, because if they produce more log, they have to lower their prices, and that helps the downstream firm and gives them more profits. Right? So if you want to think of quantities, there will be positive externalities, so they won't do enough of it. So that means they'll underproduce.
And so basically, if we are talking about a negative externality with respect to price, so they will charge a higher amount is in the pre-merger case?
Yes. They'll charge a higher amount and produce too little.
Okay. Thank you.
Okay. Now, this idea can be applied to many. One of the arguments about the importance of nation states, right? So as Europe came out of the Middle Ages, before that there were lots of small kingdoms, many different sovereigns, and many different taxation authorities, right? So merchants who were taking products produced in one place and taking to another place, they often had to pass through multiple small kingdoms or sovereign entities, and each of them slapped on a tax, right? So there were many, many taxation authorities. Now, when you have a political consolidation, meaning that various small kingdoms merge to become one large nation state, and then you have one taxation authority, then it can be a Pareto improvement, right? Tax revenues can go up, and the profits of the businesses could go up, and consumers could face cheaper prices and be better off in the process. So that was one of the economic benefits of consolidation of smaller political entities into nation states that one can cite. Now, and for exactly the same reason, you can hopefully see the parallel here, right? The multiple taxation authorities are like multiple monopolists, right? Now, you can extend the same to the modern situation. So if we have, in India, we have this federal structure. So the state governments can impose taxes, and the central government can also impose taxes. And if we have some business, manufacturing, let's say, not to complicate matters, let's say, there's somebody has set up a smartphone plant in Noida, right? So they have to pay taxes to the UP government as well as to the central government, right? And so if you have multiple taxation authorities taxing the same product, the outcome can end up being Pareto inefficient for the same kind of reason that we were talking about here, right? And if the taxation authorities somehow merge, then that can make things better for everyone. What is an example of that? Taxation authorities merging and applying one single tax.
GST?
It's the GST. Okay. So there's a few slides here where I have illustrated this principle. Now, GST, of course, has many different aspects, right? But one aspect is this, which is fiscal consolidation, which is that when multiple governments slap on their own taxes on a product, the overall tax burden turns out to be too high. Okay. What this little model shows is that if the tax authorities merge and decide they'll charge one single tax, which they'll split up the revenue according to some revenue sharing formula, what will happen is that the combined tax rate will actually go down. Yes. Yes, one second. Let me just finish what I'm saying, and then I'll take your question. So the combined tax rate will go down, and as a result, something quite remarkable should happen theoretically, which is that tax rates go down, right? If you take the combined state and center taxes before GST or merger, and if you combine with the new tax regime GST, the combined tax rate should be lower after we have something like GST. So obviously businesses and consumers should be better off for that reason. They're facing lower overall taxes, but tax revenue should also go up. Yes, there was overtaxation before when there were multiple taxation authorities, right? Now, I'm not going to go through the steps of this. I'll ask you to kind of read it up. The logic is pretty much the same. It's just a different context. That's why. So for lack of time, I'll leave that to you to again, the intuition is exactly the same. When the state government increases its tax rate, right, it might increase its own revenues, but it has a negative impact on the revenues of the central government, doesn't it? Right? Because if the state government, other things equal, if the state tax rates go up, that means volume of trade shrinks, and that reduces the tax base of the central government. So it has a negative impact on the tax collection by the central government, and vice versa. Exactly the same logic applies in the other direction. So when they're choosing their tax rates separately, they don't internalize this negative externality they're imposing on the other government. And that's why the tax rates end up being too high. Okay, so after the merger, they'll find it optimal to reduce the combined tax rate. As a result, their revenues will go up, but consumers and businesses will also benefit because they're facing lower taxes overall. Question?
Also,
yes.
Yeah, so I have a question. You said that after the merger, tax rate will go down and it would also increase the revenue of the government.
Right.
So if we are on the right side of the Laffer's curve, then this condition will be true, I guess.
That's right. So the Laffer curve.
So like you are saying that if the.
Yeah, go ahead.
So you are saying that before the merger, we were operating on the right side of the Laffer curve, and after the merger, like we are shifting like towards the like optimum.
Towards peak, yeah.
So you had made the implicit assumption that before the merger we were operating on the right side of the left curve.
I didn't make that assumption. That's a result. Before the merger, when the tax authorities are acting in their own self-interest to maximize their own tax revenue, they will end up being on the declining part of the Laffer curve. That's what will happen.
But if they are individually on the like
okay, go ahead.
Yeah, so but like if individually before the merger also, if state government say was on the declining part of the Laffer's curve, for that matter also, if they reduce the tax, then also they can gain before the merger also.
They can in principle, but it won't be in their individual interest to reduce the tax rate. When the idea here is game theoretic actually, and so you're not yet have been introduced to game theory, but some of you have taken a special paper. There's a famous game called the Prisoner's Dilemma. Yes, and in the Prisoner's Dilemma, what happens is that two people. Let me very quickly tell you. Okay, can I take 10 minutes extra, guys?
So
yes,
yeah, no problem.
Okay.
Yes, so.
So there's a famous game called. Let me quickly talk about the Prisoner's Dilemma. All right. You don't have a class now, right?
Yeah, so we don't have a class right now.
Okay, so if you will indulge me, I'll take about 10 minutes and then I will end. Okay.
So is this generally the case with horizontal mergers? So this is a horizontal merger example, right? Center and state driving a.
Well, it's a vertical merger. So the way in this little model, if you look at it, I am not going through the details. The way it has been laid out on the slides is that first the central government has the first pick, right? The center first picks its tax rate, and then the state government chooses its tax afterwards. So it is exactly like that upstream downstream monopolist story, right? That the logging company first chooses its price, and then the other company decides how much to buy and what their own price of furniture should be. Now, it doesn't matter actually. Instead of sequential decision making, we can also model it as simultaneous choice of tax rates, and that'll produce the same result. Yeah. The reason I kind of I'm talking about the two in the same breath is because the fundamental economic intuition is similar. Let me quickly talk about prisoner's dilemma. So imagine you are playing a game. You're in the lab. You've been asked to play a game. You're sitting at a computer terminal or something, and the game is as follows. You've been given 100 rupees, yes? And the experimenter tells you that you can either keep that money, or you can give it to the other player, who is somebody who's anonymous, who's in some other room. You don't know who this person is and will never meet the person, right? So you can either keep the 100 rupees for yourself, pocket it, or you can ask the experimenter to give it to the other person, all right? And the other person has been given the same choices. The other person also has been provided 100 rupees, which she can give to you or keep for herself. So if both of you decide to keep for the money, both of you get 100 rupees. If both of you choose to give to the other, according to the rules, the money will be, the experimenter will triple the money. So if you give your 100 rupees to the other player, it will end up being 300 rupees when she receives it, okay? So if both choose to give, it's 300, 300. Now, what if I keep my money and the other player has chosen to give? So I keep my 100 rupees and the other player has given, which is another 300 rupees for me. So I get, in that case, 400 rupees.
400.
And the other person gets 0. And over here, it's 0 and 400. First number is the payoff of whoever is choosing the rows. The other is whoever is choosing the columns. Now, here, keeping is what is called a dominant strategy, right? Why? Because if the other person is choosing to give, if I keep, I get 400. If I chose to give, I would get less, 300. Now, if the other person is choosing to keep instead, then by giving, I earn 0, and by keeping, I earn 100. Whatever the choice of the other player, I earn more money by keeping rather than giving. But if both people choose to keep, they go home with 100 rupees each, and there was a Pareto superior option. If both chose to give, they would go home with 300 rupees each, right? And again, if you try to think of it, you can think of it in terms of externalities. When I give, I make a loss, but I impose a positive externality on the other player. The other player gets even more than 300, which is 300, right? And I don't count that if I'm selfish. So this is an example where everybody, each side, each player, each party is acting rationally in terms of self-interest, but the group outcome is Pareto inferior, Pareto inefficient. So what's happening in these examples, but the upstream, downstream monopolists or the multiple tax authorities is essentially what you see in this simple prisoner's dilemma game. That somehow just everybody acting in self-interest doesn't produce nice results. And this is very much in contrast to the invisible hand idea, The invisible hand idea says that in a particular kind of context, namely perfectly competitive markets, individually selfish behavior still gives rise to good group outcomes. But it requires a lot of assumptions, a lot of structures. And the prisoner's dilemma is a good counterexample that you can't generalize that lesson, that idea. And these other things that we talked about today are also similar ideas. Question?
Excuse me, sir.
Yes.
Sir, in case of GST, we still have the IGST, right? So that would essentially still apply if we're trying to transport goods between states. So how would that help us reduce the tax rate? While it might reduce cascading effect of taxes, how will the overall tax rate reduce?
Yes, so the GST you have may have different components, right? The state GST part, the central GST part, or what have you. But the point is that they're chosen by the same authority who is just trying to maximize, or who has at least as one of the objectives is to keep an eye on the total collection, the total kitty, right? So the division of, calling some part state GST, some part something else is just an administrative nomenclature, right? The point is that different entities are not choosing the different components. The same entity is choosing the different components. And that leads to internalization of the interests of the states as well as the center.
All right.
Sir, but how would simultaneous and sequential games have same outcomes?
I'm not saying they have same outcomes, but they have the same qualitative property, namely that the outcome would be Pareto inefficient. The exact number would be different.
Okay, sir.
Yeah. All right. Now, I wanted to end, I've run 10 minutes over time. 8 minutes over time. Okay. I've finished the monopoly topic. I'll take further questions in contact hours if you have. I just wanted to end showing you a short video clip. It's about 6 minutes, and have a little discussion on it to tie up the whole first half that I talked about, sort of some big takeaway lessons. Shall I do it? That'll require another 10 minutes or so.
Yes, sir.
Yes, sir. Yes, sir.
Yes, sir.
Yeah. Okay, so before the video, this is, stepping back and looking at all the things that we have talked about. So let's very quickly review it. And I'll highlight a few things. So let me, at this point, stop sharing. Change the view. Okay, so what are the major takeaways? The sort of overarching question is we want to understand how markets function, because we want to understand how a market economy promotes or does not promote social welfare, the interests of the participants. One of the ideas that you saw is the first welfare theorem, which says that, absent externalities, absent public goods, absent informational problems, under kind of classical assumptions, market outcomes are Pareto efficient. Now, Pareto efficiency, mind you, is a very concrete and narrow criterion. When we say markets are efficient, that doesn't mean markets are superb and nobody should ever touch it. And there should never be any kind of policy intervention. No, if Pareto efficiency, saying that markets are Pareto efficient is almost damning them with faint praise, right? It just means that there's no money left on the table. There's no deadweight loss. If starting from the market outcome, we want to make some people better off, somebody else's interests have to be sacrificed. Now, of course, we may be, if an outcome is Pareto inefficient, then that's pretty bad. Then there's obvious improvements. If an outcome, market outcome or otherwise, is Pareto efficient, that's like saying, all right, there's no obvious improvement, but still we may really dislike the outcome, right? So if there's a way of making a lot of poor, starving people much better off by reducing the profits of the super rich, many of us may want to say that, well, it's worth doing it. Now, you'll see the first welfare theorem in more general after you talk about general equilibrium in the second part, right? You'll see it in its full glory, but the basic idea is the same. You'll also see the second welfare theorem. What does that say? Again, you'll see it in all the detail and the proofs and everything, but it will basically say that if you don't like the market outcome because you think it's very unequal, and you want to create, intervene in the market for equity reasons, for income distribution reasons, the best way of doing it is to rearrange the endowments that various agents have, right? So for example, you may want to sort of do land reform. You may want to take land from big landowners and give some land to the landless, right? Redistribute assets, wealth, stuff like that. Don't try to tinker with prices. Don't do it with taxes and subsidies and quotas and such things. Just redistribute wealth and assets. That's a more efficient way of doing it. That's the key idea of the second welfare theorem. And we saw again, in our partial equilibrium analysis that we have done in the first part, we have seen that, I talked repeatedly about lump sum taxes and transfers being the ideal way of redistribution, right? Instead of taxes and subsidies, because taxes and subsidies create distortions and create deadweight losses. Okay, well and good. We also talked about the fact that, these are theoretically ideal ways of redistribution. So for example, the government tries to redistribute income towards farmers through MSP, through subsidies for electricity, fertilizers, etc. That obviously creates its distortions and deadweight losses, So ideally, the best solution is something like DBT, right? Just putting money in the bank accounts of farmers. But that might lead to lots of inclusion and exclusion errors, especially exclusion errors, meaning, how do you identify who's a farmer? How do you identify who's poor? That's one problem. The other problem is that, you may not have the mechanism to transfer money into the bank accounts. They may not have a bank account, or the bank account may not be on the record, and so on and so forth. So for example, the government has, these 6,000 rupees for farmers, right? PM Kisan. But it goes only to farmers who have land records, who have small amounts of land, less than 2 acres. It doesn't go to landless laborers, for example, who are even poor. So lots of people are left out. So that's why, some economists who haven't understood everything, they often say, reflexively, they'll say that all these taxes and subsidies are bad. But there's a delicate balancing act. The taxes and subsidies create distortions, but often they keep exclusion errors down, right? And if we switch to DBT, that's the trade-off that is involved. Anyway, point is, many kinds of policies that you see, which may create some inefficiency, are motivated actually by egalitarianism, by the need to have more inclusiveness in our society, right? So just going at them hammer and tongs, saying, these are inefficient, these are distortionary, is a bit naive as a reaction. We have to also see the other side. Okay. So income distribution is very, very important. And if you look at the world today, the experience of America, of Europe, and all over the world, a lot of the reactions are because inequality has gone up significantly. All right, now the clip I wanted to show you goes beyond that, right? When we assess markets and how do we think about markets, as I said, one reason to intervene would be, none of the results, first welfare theorem, second welfare theorem, none of them say that the market will create some nice equal income distribution, right? Income distributions are often shaped by our past practices, for example, like the caste system or, feudalism. At that point, a lot of inequality was created. Some people captured, a few people captured a lot of land, and some people were left landless. And even after we transition to a more capitalist market economy, a lot of those inequality would tend to persist through the generations. So we may want to correct it. Okay, but other than inequality, there's another